Hey everyone, in this particular video we are going to cover the Financial Stability Report December 2025. So this is all about Financial Stability Report. In RBI, in Reserve Bank of India, we do have a Financial Stability Department. We have a Financial Stability Department. Now this department is actually working on preparation of the Financial Stability Report as well as the analyzing the financial stability in our economy, right? So we all know that this is a half yearly publication. That means it is going to be published twice a year, right? So ये December 2025 की report है and it is nothing but a collective assessment. It is a collective assessment of the subcommittee of Financial Stability and Development Council, right? So this is a collective assessment on the current and the emerging risk related to the stability of the Indian financial system, right? So here we are analyzing the current and the emerging risk to the stability of the Indian financial system. So particularly this report is divided into three major chapters. Chapter 1 is related to the macro financial risk. Whatever risks are prevailing globally, we are going to discuss about that. Then financial institutions, soundness and resilience, and in chapter 3 we are going to discuss about the regulatory initiatives in the financial sector. So guys, I always tell you that reports are nothing but, I will say, a combination of a compilation of the finance, current affairs, RBI circulars and a lot of other related information as well. But specifically in the Financial Stability Report, you will be having the stress test as well related to each and every criteria of the economy, right? So let's get the discussion started, guys. This is the summary of the Financial Stability Report, which is also published by Reserve Bank of India only. So they always highlight the core things, like we can have a just quick reading of this core summary and then we'll be definitely doing the detailed discussion related to this report. The very first pointer is related to global economy. It has been resilient and it is supported by the fiscal measures, front-loaded trade. That means in the first half of the financial year, most of the trade has taken place, and strong AI related investment. We all know that AI is on a boom and all the money is getting into AI related investment nowadays, right? However, there are certain downside risks as well related to the elevated uncertainty, high public debt and the risk of disorderly market correction. Why? Because as of now, I can say that the valuations are quite high. So that's why when the valuations are high, there is a risk of correction, right? There is a high probability of correction also, right? Then we will be discussing about the global financial market. It is appearing strong on the surface, right? But shows growing underlying vulnerabilities. That means on a surface level, it is strong. It looks strong, but there are certain vulnerabilities which can definitely affect the strength, right? Then we'll be discussing about the Indian economy as well. It is growing strongly because we do have a very good domestic demand, right? We have a robust, we have a strong domestic demand. Similarly, we will be talking about scheduled commercial banks, NBFCs, right? Whatever macro stress is there on the SCBs and the NBFCs and the insurance sector as well. Plus mutual funds, clearing corporation, each and everything we are going to discuss in the Financial Stability Report, right? So always start reading the report first by reading the summary so that you can have a broad understanding of whatever things are going to be there in the report, right? So let's quickly start the detailed discussion, guys, now. So guys, let's start with the global macroeconomic risk, macro financial risk. So the global growth has been proven to be more resilient, more strong than the expected, despite of the trade tensions, geopolitical risk. We all know that we are having geopolitical risk and trade tensions specifically related to the US markets, right? Emanating from the US markets, and uncertainty about the economic policy. Still, we can say that the market, the global market looks resilient only, and there is a very strong AI related investment, right? If we talk about the scheduled commercial bank, soundness and resilience of scheduled commercial bank, it is also robust with strong liquidity and capital buffers. Now every bank has to maintain certain strong capital and liquidity buffers, and we are going to discuss about each and everything which is mentioned in this particular report. So no worries at all, we'll be covering the dynamic part as well as the static part of the report, right? I'll be also teaching you some of the new concepts which you might have learned in the trend and progress analysis report as well, and in this report also we are going to have a detailed discussion related to each and everything, right? Now, primary urban cooperative banks, UCBs, with some exceptions, remain healthy with sound capital buffer and continued strength in the profitability. So here you need to note that some exceptions were there, right, in the UCB side that we are going to definitely discuss. So this is the chapter 1 related to macro financial risk. Whatever risk are going on in the macro environment, we'll be discussing in this particular chapter, right? So we have also seen related to the strengthening of the global environment in terms of finance, and here we can see that the IMF, International Monetary Fund, has revised its global growth projection. IMF has revised the global growth projection, right, to relatively higher than the previous reported figure. Now it is 3.1%. Earlier it used to be 2.8%, right? So IMF is also positive related to the macro fundamentals, macroeconomic fundamentals of the economy here, right? So resilience despite of facing so many risks. Downside risk still is there, right? Because we do have elevated public debt level, stretched asset valuation, right? We are sitting almost at an all-time high stock market as well, almost all the countries, right? And geopolitical tensions are also there. Still, IMF is quite positive and has revised the global growth projection, right? So risk of asset vulnerabilities are also there, plus private credit and hedge funds. Growing interconnection between bank and NBFCs. Now we all know that all the economies are interconnected. So failure of one bank or financial institution or NBFC can definitely bring a systematic risk in the entire world, and it will not be related to just one economy. It won't be capped at one just economy, it will be widespread, right? We have seen it in the 2008 financial crisis only. That's why we are working so hard, right? The Reserve Bank of India and all of us, right, including you guys, are working so hard in learning so many details in the financial stability report. Why? Because there's a big problem of systematic risk. Even failure of one big organization can cause a widespread risk, right? Hedge funds are also increasing their leverage in the US Treasury market, which is again one more vulnerability. Why? Because whenever you increase your leverage, right, there is a higher amount of risk. You want to increase your return. So the return and risk will always go hand in hand. The return will increase, but the risk will also increase, right? So here we can see some of the latest data. We can see that the latest data related to external debt to GDP is at 19.2%, right? Inflation data we can see here at 1.8%, CAD at 0.8%, and all these are the macroeconomic fundamentals that we have as of now, right? Now this is called as India VIX. What is VIX? This is not that VIX जो आप समझ रहे हो. This is volatility index. What do you mean by sir volatility index? Volatility index means how adversely your stock market can react, right? Your fundamentals can react. So I can say that the higher the volatility, the higher will be the risk, right? Volatility means changes. Now changes can be upside as well as downside, right? So I can say that if a particular index or security is having a high standard deviation, then that means there will be a very high level of volatility, and India VIX is nothing but volatility index of the entire country, right? So if India VIX is high, then it states that there can be a quite good amount of correction in the market, which is actually bad for the economy, right? So as of now, India VIX is at 10.9 level, right? And if we talk about the domestic outlook, then the real gross domestic product, GDP, I'm talking about the GDP, surprised on the upside in both quarter 1 of financial year 2026. Now I am talking about FY 2026, quarter 1 and quarter 2, right? Quarter 1, 7.8%, quarter 2, 8.2%, which is quite surprising. And why? It is coming from directly strong private consumption and public investment in India, right? So in India, we do have a very strong private consumption. Because of that, Even if due to global risk or geopolitical risk, it remains unaffected. We are growing at a very good pace, right? Then we can see that the S&P Global Ratings also upgraded India's sovereign rating from earlier BBB minus to BBB in August 2025. So I can say that we are doing well in terms of GDP growth rate as of now, right? Here we can see in chart as well 8.2%, which is the Q2 financial year 2026 ka GDP year on year increase percentage, right? And these are some of the projections as well. You can see that RBI is also having the latest projection at 7.3%, and similarly all the organizations like World Bank, IMF, OECD, they are also doing prediction related to each and every country. Now the overall debt to GDP ratio, how much debt you have, debt means loans, long-term loans, how much debt you have in comparison to your GDP, remains around 82%. Let's suppose if you are having 100 rupee as your GDP, 82 rupees you have taken a loan, right? So this is largely due to elevated state government debt. In India, the state government debt is too high, and because of that, the overall debt to GDP ratio is also high, right? CAD, current account deficit, we all know that we are doing business with so many countries, so we have a current account balance always, right? How much we are exporting minus how much we are importing. So we can see that the CAD, current account deficit, has widened. We have a deficit, so actually we are a net importer country, right? Has widened. Earlier we used to have 0.3% in Q1, and now in Q2 we have 1.3% as a CAD, which is not so good sign for the economy. The CAD is widening. That means we are a net importer and we are importing more and more things from the rest of the world, right? So here we can see the current account deficit level as well, which is at 1.3% as of now. Okay, and you have a rough idea like how this line is moving usually, and as of now we are in the negative territory, right? So global financial market, let's talk about some financial market related stuff. So we have seen that there are elevated valuation, the valuation is quite high, and there is a risk of concentration. Why? Because of the AI related investment. In the equity market, specifically in United States and Asian indices, we have seen stretched valuation. That means they are overvalued because of the AI related stuff, and we have seen the AI related stocks going up in 2025 as well as we are seeing in 2026. They are continued to go up with time, right? So AI investment boom is definitely there. Now if I talk about the financial conditions, despite of the global quantitative tightening, ample of liquidity support was given in the economy, and strong flows in mutual funds and ETF we have seen, right? Nowadays retailers are also pouring money like crazy in the mutual funds and ETF, which is a good sign for the economy, right? And gold prices and silver prices, we have seen that they are at a all-time high. Now there is a crypto market volatility. Now you guys can see that in every report we are having something or the other related to cryptocurrencies, blockchain, or specifically stable coins. Today also we do have, right? And this becomes one of the most crucial topic for your examination. A very high probability that you will be getting one question specifically in the descriptive side. Definitely question can come in the objective as well, but I think that there will be definitely a descriptive question as well related to cryptocurrencies, particularly on the stable coin side. Okay, so that's a very high probability question. I'm telling you in advance. जब भी आपका एग्जाम होता है 5 months, 6 months, 7 months बाद, तो डेफिनेटली ये वाला आपको टॉपिक एज देगा. सो प्लीज डू प्रिपेयर दी स्टेबल कॉइन, ब्लॉकचेन, क्रिप्टोकरेंसीज, DeFi and rest of the stuff. I already definitely teach these kind of things in the paid classes. And in case if you are having any query or you would like to learn something new related to finance, you can join me on Telegram. If you type CA Pratik Finance on Telegram, you will get my group. Okay, I frequently share finance related content on that. Now definitely we are going to discuss about each and everything here in a slow and steady manner here. Domestic financial markets, eased financial condition. Indian financial condition has eased due to monetary easing. Now what do you mean by monetary easing? RBI is cutting down the rate, right? RBI is in every meeting RBI is slashing the rates repo rates I'm talking about, right? So that's called as monetary easing. Why? Because now loan is available at cheaper interest rates, so definitely there will be a high level of liquidity in the market. Plus RBI is also boosting the liquidity by doing so many operations, like open market operations and USD by INR swap and same, right? So everything we are going to discuss slowly here about the mutual funds, about the passive funds, about the household financial assets as well. Specifically in chapter 2 we are going to discuss about this stuff. Now the next is a strong IPO trend. Now what do you guys mean by IPO? Have you guys ever heard about the term IPO, OFS, offer for sale, or fresh issue? Have you guys ever heard about this term? So guys, IPO means initial public offer. Now the name says it all. Initial public offer, you are offering the shares to the general public, but for the very first time. That's why we say initial public offer, right? So we can see an increasing trend in the IPO, right? In the IPO, specifically in the fresh issue side, right? In the fresh capital raising, we can see an increasing trend here. Now, let me just give you a quick understanding. Say for example, there is a company ABC Limited. There is a company ABC Limited, which is going for an IPO. Which is going for an IPO of 1 lakh shares. Of 1 lakh shares, right? Now let's suppose I am the promoter of ABC Limited. I am the promoter of ABC Limited. So I am also having some shares. Right? So we have decided that 40,000 shares I will contribute as promoter. I will sell my own shares. Right? We have to offer 1 lakh shares to the general public. We have to offer 1 lakh shares to the general public. So I am contributing 40,000 shares, and ABC Limited will be issuing fresh shares, new shares, $60,000 shares, right? So 60 plus 40,000 shares comes to 1 lakh shares. So ABC Limited has to issue 1 lakh shares. I am contributing, I am selling my own 40,000 shares. Promoter, the owner of the company, is selling 40,000 shares, and rest of the 60,000 shares, it will be a new issue, it will be a fresh issue, right? So these 60,000 shares are newly issued shares in the market, and the money coming from these 60,000 shares will directly go to ABC Limited. But the 40,000 shares, that are my shares, that are not company's share, right? I am owning those shares, so I am issuing the shares, so the money that will be coming from the 40,000 will come in my pocket, will go in my pocket and not the company's pocket, right? So this is called as offer for sale, where the promoters are liquidating their own shares, right? So that's offer for shares, offer for sale. And what do you mean by fresh capital raising? This is fresh capital raising, right? That's the difference between OFS and fresh issue. So in IPO, it can be via OFS, it can be via fresh issue, or it can be via combination of fresh issue and OFS, just like we discussed here in this particular example. Here we can see that the assets under management, AUM. What do you mean by assets under management? How many assets are there under the management of a mutual fund company? Let's suppose all the retailers have invested 80 lakh crore rupees, then that will be the asset under management for the mutual fund company. That are the money, that is the total amount of money the AMC, the mutual fund company, is having, right, in the business to invest in stock market, or maybe they have already invested in stock market. So that's called as assets under management, right? So the domestic mutual fund industry's asset under management, AUM, which is a very important term in the mutual fund industry, is now 80.8 lakh crore, right? And it has almost 18.7% growth as compared to the previous year. Now, why it is increasing? Because of the robust inflows coming through the systematic investment plan. Now, retailers are having so many SIPs in the mutual funds, and because of that, the AUM is growing aggressively every month, right? If we talk about the corporate sector, then steady sales and profitability we have observed. Debt serviceability and leverage is also fine, it is also stable, right? We have also studied that the sales growth of the listed non-government non-financial companies NGNF has improved to 8%, right? It is growing by 8%. I'm talking about the sales growth. Right now, the same data we have also covered in the finance current affairs session. It was published in the RBI website also कुछ time पे पहले से. Household sector, we have seen that household sector debt stood at 41.3% of the GDP. So whatever GDP we are having in country, out of that 41.3% represents as the household sector debt, right? Now this is a sustained increase, I can say, because the 5-year average is of only 38.3%, but as of now we are having 41.3% as the debt to GDP ratio pertaining to the household sector, right? Pertaining to the household sector. And here we can see the composition in the financial asset as well. Now, limited financial market penetration in India is still a big problem. Despite of that much awareness, so much of finance related content and SEBI and RBI initiatives, only 9.5% of the households are actively investing their money in the security market, right? And that too mainly the people are living in the urban areas as well. So the rural market penetration is still pending, right? Then we'll be discussing about the banking system in India also. So here we are having so many terms like CRAR, LCR, GNPA, NNPA. I'll be talking about each and everything in a very detailed manner, guys. Not just the dynamic numbers, but also the static concepts also in this particular video. So about the ratios like CRAR, I'll be definitely discussing, but after 5 to 10 minutes, okay? So CRAR as of now is 17.2%, LCR is at 131.7%. I'm talking about here the scheduled commercial banks. So the bare minimum LCR requirement is 100%, right? CRAR also we discussed in the trend and analysis report, right? Trend and progress report of Reserve Bank of India. GNPA 2.2% and NNPA 0.5%. Here we can see that the bank's profitability is also having a stable growth and the credit is also growing at 11%. Right now, the same things we have studied in the BSR report as well. BSR 1 related to credit, BSR 2 related to the deposits, right? So here in a chart format, let's discuss about each and everything. These are the gross advances. So if you are a bank, you will be giving some loans and advances, right? What a bank is doing, accepting deposits and giving advances, loans and advances. So we can see that year on year basis, the gross advances are expanding like anything. And as of now, we have 189 lakh crore ka figure in the gross advances. The gross NPAs, that means how much money is becoming non-performing asset. So what is an NPA? Let's suppose I have given you a loan. Now you guys are not able to pay me back the loan. So it will be an NPA, right? After 90 days of becoming overdue, it will be an NPA, non-performing asset. That means I'm not able to realize anything out of that loan as of now. That is called as an NPA. And going down of the NPA numbers is a good sign for the economy. Have a look. In March 2017, we are having only almost 10% of the advances as NPA. Now that's a crazy number, right? And as of now, we can see that we are at an all-time low of 2.2% in case of gross NPA, which is quite a good number, right? For any economy, which is quite a good number, which India has already achieved it, right? If I talk about the net NPA, again, we are at an all-time level low only. And this number is quite stabilized as compared to March 2025. In September 2025 also, we are having 0.5%. Now, what is the difference between gross NPA and net NPA, right? Gross NPA minus provisioning. Now, why I have to do the provisioning? Because I know that I won't be able to realize full money from these gross non-performing asset. So why not to make provisions? Because I am prudent, right? Every bank is prudent, is intelligent. So that's why the banks will be setting aside that money that maybe they are not able to recover it. That's why they are making certain provisions. They are already making certain provisions. And do remember, provision is a charge against profit. Provision is a charge against profit. And that's why bank is creating a charge against profit. Let's deduct this advance right now from the profits because you guys are not able to recover the full amount, right? So provisioning in the GNPA, if I do the provisioning, I'll be getting the NNPA, which is the net non-performing asset. Both are at an all-time low, which is a good sign. return on asset, how much return you are able to generate on your assets. So the formula is a return, which is also called as PAT here, profit after tax. Whatever profit you are able to earn after paying taxes divided by the assets. Now this shows how much profitability you are able to generate on your assets, right? Return on asset. And we can see the band of the ROA continuously expanding, and as of now we are having a 1.3% ROA. That means we are able to generate 1.3% by using all the assets in our business. Okay. CRAR, capital to risk asset ratio, which is also called as capital adequacy ratio, right? CAR. It is also at an all-time high here at 17.2%. Now earlier in March 2025 we used to have 17.4. It's there's a slight decline in it, 17.2%, but it is quite good and above the bare minimum regulatory requirement, right? Then we have the LCR, liquidity coverage ratio. Now this is a ratio which states how much liquidity we have in our business. No worries at all, we'll be definitely doing a detailed discussion of all these formulas. So even if you are not able to understand these formulas now, just focus on the number, and in 5 to 10 minutes I'll be telling you the concepts as well. Okay. So LCR stands for liquidity coverage ratio, how much liquidity you are having in your bank, right? How much liquidity. Now bank is doing a risky business. Why? Because you take deposits from the general public and you give loans and advances. So at the same time you need to keep certain deposits with you, right, in the form of liquid assets, and that is very much required, because if you don't have enough liquidity, what if somebody comes to your bank and asks for X amount of money and you are not able to deliver it? Now that will be a reputational loss for the bank as well as a financial loss. So liquidity coverage ratio is very essential, and we can see here that the liquidity coverage ratio is continuously in the uptrend only, right? 131.7. Bare minimum liquidity coverage ratio we need as per the RBI guidelines is 100% for the scheduled commercial bank, and we are maintaining a very well 131.7%, which is quite above the bare minimum level, and the provisioning coverage ratio is also at an all-time high of 76% here. Slippage ratio, how much of your advances are turning into NPAs, how much of your advances are turning into NPAs as a percentage. So if something is turning into an NPA, then that is bad, right? So it should not be high. The slippage ratio is better, lower the better. So as we can see that the band here of slippage ratio is also contracting, which is quite good for the banks, right? 1.4%. So the data is quite good in all the parameters, I can say, related to the domestic bank, scheduled commercial bank, right? Funding and asset composition, increased reliance on equity capital. Banks are relying too much on the equity capital. Deposit growth moderated. Now we don't have so much of deposit growth, and I'll be definitely talking about the deposit growth and credit growth in terms of data as well, right, in few minutes. Stress test. The macro stress test reaffirms resilience with the CRAR. There is a stress test whether a bank will be able to, cope up with the adequate amount of stress or not. So here the decision is, the observation is that CRAR will be definitely remaining over and above the regulatory requirement only, even in the adverse scenarios, and we'll be talking about that as well, right? Now NBFC related discussion also we'll be doing in chapter 2 of this particular report. There is a special column here in the report which is related to the financial stability implication of stable coins. I will say this is one of the most important thing for your examination from this report. Now the same thing, right, definitely in a different language is there in the trend and progress report, as well as it is there in the financial stability report also, which makes it super duper important for your upcoming RBI Grade B examination. I will say that a very high chance that you will be getting a descriptive question on this concept of stable coin, or maybe cryptocurrencies, or maybe blockchain technology. So this becomes a very sweet spot for you to target for the RBI Grade B examination 2026. I will say a very high probability question can be framed from this area because of the increasing importance related to this topic. And in 2025 also definitely I have marked this topic as important, but it didn't came in the examination. They asked just one objective question in the examination. I will say for 2026 there is a very high chance, more than 60 to 70% chance that you can get a descriptive question based on this concept of stable coin, cryptocurrencies or blockchain technology. Mark my words. Okay. So stable coins are emerged as key component for the crypto asset ecosystem. We do have crypto asset ecosystem where we do have so many cryptocurrencies like Bitcoin, like Ethereum, right? Like Solana. And similarly, in that ecosystem, we are having some stable coins as well. Now there are two types of coin. One is Bitcoin, Ethereum and similar like coins. We have hundreds, thousands of coins here, right? Like Bitcoin. But there is one more categorization which is called as a stable coin, Now what do you mean by stable coin? Stable coin means something which is bringing stability in the market. That means there are not too many fluctuations. That means there is not high degree of volatility, right? Just like we have in Bitcoin, in Ethereum. One move and it is either 10%, 5% up or 5%, 10% down. Now that much volatility is not there in the stable coins. That's why in the name says it all, these coins are stable. Right? Maybe because they are pegged to some currency. They are aligned with some currency. So for example, USDT. Now I have given the same example in the trend and progress report also. That is a stable coin. Why? Because this is pegged to US dollars. So the company behind USDT, which is Tether, says that they are keeping in backing $1 for every 1 USDT issued. So if they are issuing 1 USDT, then in the backing they will be having $1 for it. So I can say that this makes USDT as a stable currency, right? It makes USDT as a stable currency here. So is it so stable that we don't have to worry about it? No, there are certain kind of risk as well, because you can't treat this as a real money. I told you in the trend and progress report also, this is definitely a stable coin, but it is not similar to the concept of money, right? And BIS, Bank of International Settlement, has also highlighted the same thing, right? And it is covered in the Financial Stability Report as well. That's why I'm saying this can be one of the most crucial area from which you can get a question in the examination. So what I will advise you guys is to don't read this particular table in a summarized manner. Once my session is done, just download this PDF and reread the entire table. As of now, I'll be covering the crux of this table. But what you guys have to do is there are 3-4 pages related to stablecoin. After the session, download this PDF and read it very well. Definitely you will be having one question from this concept, right? So we have multiple stable coins as well, like Tether, which is USDT. We have even USDC, right? Now these account for around 85% of the total market capitalization of the stable coins, right? So whatever stable coins we are having, these account for 85% of the market capitalization, right? What are the purpose and benefit use case? Now cryptocurrencies are quite volatile and these currencies are not so much volatile. So if you want to park your money in a stable currency, in the cryptocurrencies, then stablecoin becomes a apt choice, a perfect choice. Now we can say what is making actually the stablecoin so special, why people are using it. So the most dominant use as of now of stablecoin is why? Because if let's suppose you want to buy big Bitcoin, so you go to some of the platform, you convert that money right into the stable coin. You are buying some US dollar Tether or USDC with that money, and then with the help of your USDT, your USD Tether, your stable coin, you are buying the Bitcoin, right? So your INR will be converted into first USDT, which is a stable coin, and then with the help of USDT, you are actually buying the BTC, right? You are actually buying the BTC. So that's how it works as of now. And as of now, 80% of the trading volume of the exchanges are coming from the stablecoin. That is the importance of stablecoin. Later on, definitely you can read this, and the financial stability risk which is emanating from stablecoin, definitely super important. Okay. So we learned that there are 3 concepts. If you want to have, if you are considering something as money, there should be singleness, elasticity and integrity, which I have already explained you in the trend and progress report of the Reserve Bank of India. So I'll advise you guys to please have a quick reading related to the entire paragraph of stablecoins, right? Now let's discuss about the chapter 2, where we'll be covering already about the UCBs, insurance sectors and so on. So chapter 2 is about the financial institutions, soundness and resilience, how sound, how strong or how quickly our financial institutions can recover from any kind of stress, right? So we can see that the Indian banking sector continued to remain robust with strong capital and liquidity buffers. We are having very strong capital and liquidity buffers to sustain any kind of stress scenario as indicated by the Financial Stability Report. So we can say that our CRAR is quite at a good level of 17%. I am talking about the scheduled commercial bank. NPAs, gross NPAs, we have already discussed. Provisioning coverage ratio, right? We have also discussed the provisioning coverage ratio. The credit growth as of now is 11%. Profitability, which is also called as net interest income, is at 2.3% and the PAT is growing at 3.8%. Now what things you have to remember here is the capital adequacy ratio, GNPA data, NNPA data, PCR data, credit growth rate. Even if you are able to remember this much data, that will be fine for your examination, right? Then we have seen that certain amount of risk is also there in the schedule on the scheduled commercial bank. So interest rate and equity related risk is there. Liquidity stress is there. Why? Because aggregate LCR remains comfortable, but few banks are actually facing the shortage under severe stress scenario. So stress scenarios are also of two types, right? First one is the normal one, right? A general stress scenario, and second one is the extreme one. So in the extreme one, few banks are again facing shortage of the LCR, right? That too in the severe stress scenario. Then we have the derivative portfolio as well. The increased income contribution from the foreign banks and MTM impacts are manageable, right? So the derivative portfolio is quite manageable. There is as of now no significant risk emanating from the derivative portfolio of the banks, right? Now here we can see each and everything at a glance about the scheduled commercial bank. The very first thing is credit and deposit. Now this is one of the most crucial thing for any bank. Why? Because let's suppose you are a bank. How the bank is earning money? The bank is accepting deposits. The bank is actually accepting the deposits, right? And then the bank is offering these deposits as loans and advances, which is also called as credit. So the bank is giving credit, right? In the economy, the bank is giving credit, the bank is offering credit. So that's how a banks earn. Let's suppose a bank is earning 6%, the bank has to pay 6% on deposits. So deposits are liabilities for any bank, and advances or credit are assets for the bank. Why? Because they are going to give future economic benefit to the bank. If you are giving loan to someone, then you must be getting interest on it, right? So that's a future economic benefit for you, right? Now if I talk about the credit and deposit, we can see that the 10-year average of the credit growth is 10.6%, and currently in September 2025 we have 11%, which is fine. We are above the 10-year average at least, right? But if I talk about the deposit growth rate, 10-year average is 10.1 and we have deposits at only 9.8%. Now this is the growth rate. This is not the interest rate I have to pay to the depositors and the I am earning on the credit. No, this is the growth rate, right? How my deposits are growing. My deposits are growing at 9.8%, whereas my credit is growing at 11%. That means I'm offering the loans and advances. That portfolio is growing at a faster pace as compared to the deposits that I'm getting in my banks. Now this is a problematic situation. Why? Because you are not able to source so many deposits and you are offering too many loans and advances. So this will definitely disturb the credit deposit ratio, which we always discuss in the finance current affairs and in so many lectures also, right? GNPA also, you can see that earlier we used to have a 10-year average of 6.9%, and as of now we are just on 2.2. So this is a good number, right? Similarly, you can check out each and every number later on. So this table will be important for a crisp understanding related to the data of scheduled commercial banks. Right, at a glance, you can have a look at the data. Now, if I talk about our deposit and credit, we have already discussed, right? Deposits and credit we have already discussed. Asset quality, GNPA, NNPA we have discussed. Now let's discuss about the provisioning coverage ratio, what PCR is all about, what is provisioning coverage ratio, and as of now we have a PCR of 76%, right? All the scheduled commercial banks, 76%. The highest PCR, which is 81.5%, is being commanded by the foreign banks, right? The foreign banks are commanding the highest PCR, and if I talk about the public sector banks, they are outpacing in terms of PCR, right? They are outpacing the private sector banks in terms of PCR. As a whole, all scheduled banks, 76 is the PCR. Now, what PCR is all about? Provisioning coverage ratio. Now, let's suppose we are having some gross NPAs in the business, right? We now need to make provisions to cover the gross non-performing assets. So, this is nothing but a ratio of provisions, the amount of provision we make as compared to the GNPAs, right? Gross non-performing assets. So, it indicates that how much provisioning I have made already as compared to the advances, right? It indicates the amount of funds a bank has set aside to cover the potential loan losses. How much losses I am having, I am going to have in the near future, plus, right, how much I have already set aside as provision. So, the bare minimum stipulated PCR as of now we have in India is 70%, and we are very well above the bare minimum prescribed range, right? Then we can have a look on return on equity, return on assets. So, return on equity we have already discussed, 12.5%. Return on asset 1.3%. What do you mean by return on equity? Return is on equity. That means how much money you are able to generate for the equity shareholders, right? Return on asset, how much money you are able to generate by using the assets in your business. Return on asset. Then we have the capital adequacy ratio, right? We call it as capital to risk weighted asset ratio also, CRAR, or capital adequacy ratio, one of the same thing only, right? It remained strong. It remained strong. The PSBs are having 16% and the PVBs are having 18.1%, which is quite above the bare minimum requirement. What is capital adequacy ratio? We have two types of capital in banks. Tier 1 capital, which is also called as going concern capital, which is very strong capital, which is highly liquid, or I can say is a very high quality capital. This is a high quality capital. Iski quality is too high. But if I talk about tier 2 capital, it is not so high quality capital, and it is called as gone concern capital. Going concern capital and gone concern capital, right? So how much capital I am having in my business divided by how much is my risk weighted assets. Now, what kind of risk is there in the asset? Bank is not a normal business. Bank is not a normal business, right? Whatever assets we have in the banks do have certain amount of risk as well. Why? Because let's suppose I am a bank, I have given loan to Mr. Mukesh Ambani. I have given one more loan to Mr. Vijay Mallya. Definitely, both are my assets. Both will be giving me future economic benefit in the form of interest and repayment of principal. But the loan that I am giving to Mr. Mallya, everybody knows that it is having a higher risk as compared to the loan that I have given to Mr. Ambani, right? So that's why both are my assets, but I can't write directly all the assets in the denominator. I need to factor in the risk element as well in all the assets, right? In all the assets. So risk weighted assets, as we can see here, this is the actual amount of assets you are having in your business. Cash 10, advances 100, investment 25, other assets 15. And now we need to give risk weights to each and every asset based on actual amount of risk. So if I talk about cash, there is no risk. So 0% risk weight is being assigned here, right? Similarly, maybe in advances, there is a high amount of risk. So we have assigned 120%, right? So my assets are only 150 rupees here, but my risk weighted asset value is 160 rupees here. Now what will happen if I increase the risk weight? If I increase the risk weight, the CAR will go down. So if the RBI is not in a mood to promote a particular category of a loan, say for example personal loan, what RBI can do is they can start increasing the risk weighted assets requirement for banks. Similarly, if the RWA increases, the bank CAR will go down mathematically, and if the CAR goes down, the bank will be facing that kind of stress. Why? Because they need to maintain a minimum CAR ratio in India, right? So that's what the meaning of CAR is. And as of now, we can see that all the banks in India are maintaining quite a good amount of CAR as compared to the bare minimum, right? Then we have the liquidity coverage ratio and net stable funding ratio. If I talk about the liquidity coverage ratio, that means in the next 30 days, whether my bank will be capable enough to handle severe stress in the next 30 days. That's why we call it as liquidity, because it's a short-term measure. It's a short-term measure of liquidity. So whether I have that high quality liquid assets in my pocket so that I can even survive for the next 30 days as a bank. So this is calculated by dividing the high quality liquid assets by the net cash outflow which is expected in the next 30 days. So whatever my expenses are there for the next 30 days, will I be able to survive by using my high quality liquid assets, is the meaning of liquidity coverage ratio. The bare minimum prescribed is 100%. As of now, we have 131.7%. Net stable funding ratio, it is comparatively a long-term liquidity measure as compared to the LCR, right? This is also called as NSFR. How much funds are available in your business? Available stable funds. How much is your availability of the fund? And compare it with the required stable funding. Let's suppose I need 100 rupees. This is the required stable funding, but as of now I have only 90 rupees in my pocket, so I can say that my net stable funding ratio will be only 90%, right? So here we can see that the net stable funding ratio is quite above the bare minimum requirement. As of now it is at 124.7, right? Now if I talk about the macro stress test, then banks have already passed the stress test. The scheduled commercial banks have passed both scenario 1 and scenario 2. Scenario 1 means gradual slowdown. What if there is a gradual slowdown in the global economy? Whether the banks will be able to survive? Yes. What if there are global trade uncertainties or unfavorable environment of trade, right? Or a sharp dent in the GDP is there. What will happen in that case? Now that is coming on the scenario 2, which is adverse scenario. So we can say that this yellow line is this yellow bar is representing the adverse scenario number. What will happen to your capital adequacy ratio? As of now, the baseline scenario, it is at 16.8%. What if scenario 1 comes into picture? You have a gradual slowdown. Your CER will fall down to 14.5%. What if there is an acute stress? There is a severe stress in scenario 2. What will happen in that case? It will go down to 14.1%. Still, it will remain more than the bare minimum prescribed by the Reserve Bank of India. So I can say that you will be able to handle the stress as well in both the adverse scenarios, right? So later on you can check out the data as well related to GNPA ratio. Again, we have examined 46 banks in the Financial Stability Report, right? And the data is quite good, even if I talk about the stress scenarios, right? Here we can see in the stress scenario as well, right? In the stress scenario 1, the liquidity risk, the liquidity coverage ratio will fall to 123 from 131 and then to the 116, right? So it is again fine, right? 3 banks would fail to meet the regulatory minimum LCR requirement in case of the stress scenario 2 is the observation of the Financial Stability Report, right? Next one is related to the urban cooperative banks. So the credit growth which is observed in the urban cooperative banks is 7.4%, right? Contributed both by scheduled as well as non-scheduled UCBs. So we have scheduled UCBs, we have non-scheduled UCBs. Overall contribution is 7.4% in the credit growth, right? 7.4%, and the non-scheduled UCBs are outpacing in terms of credit growth as compared to the scheduled urban cooperative banks. Provisioning coverage ratio here, a combined provisioning coverage ratio is at 69.2% of all the UCBs, right? And in terms of ROE, in terms of CRAR, it is doing well in terms of CRAR and ROE also. And here in the details related to the shock number 1, the severe stress, the stress and the severe stress related data is given, and you don't have to cover each and every data from the report, right? You just have to cover the crux of the report. And if I talk about the NBFCs, a robust credit growth we have seen of 21.3%, which is year on year basis, right? The GNPA, gross NPAs, are also stabilizing or declining, right? And the provisions are quite adequate here, plus fund diversification is also there in the NBFCs, right? Now here in terms of fintech expansion, the fintech NBFCs are growing too fast in terms of unsecured retail loans, with improving the asset quality also. If we talk about the stress test, the credit risk and concentration risk stress test shows overall reliance. That means overall stability is there and reliance is there, right? So NBFCs are able to pass the liquidity stress test also. However, few NBFCs have actually faced the liquidity mismatches also under the severe stress conditions. And as the banks and NBFCs are linked, that's why RBI also have a concern regarding the NBFCs on the NBFCs. Why? Because ultimately all the things are linked. NBFCs are also sourcing the credits from maximum sources from the bank only. Right, so this is the stress test data of NBFC. Sample of 174 NBFCs have taken. They have taken the sample of 174 NBFCs over a 1 year horizon period, right? Now you don't have to remember the data like what was the performance in stress 1 scenario, stress 2 scenario, and so on. Just have a quick understanding of each and everything. Then mutual funds, which becomes a very important part of the financial system nowadays. If we talk about the stress compliance, then majority of the open-ended debt scheme maintains the liquidity ratio above the threshold even in the stress scenario. Mid-cap and small-cap schemes are showing the varying days to liquidate 25% of the portfolio, highlighting liquidity risk management requirement in the mid-caps and small-cap scheme. So we can as of now see here how many AMCs are having the risk above the threshold. So 13 AMCs are there, right? As of now, how much AUM do they have, how much schemes they do have above the threshold. So we don't have to remember this data as well. So particularly about the mid-cap schemes and the small cap schemes, if we try to do a stress test that the number of days to liquidate 25% of the portfolio, let's suppose the portfolio is of 100%. Now if you want to take out 25%, right? The number of days it will take to liquidate 25%. In May 2025, it used to be 4 to 16. Then it started increasing. Again and again. And as of now, I can say if we talk about the mid-cap scheme, it is 4 to 22 days, right? So these maximum number of days are increasing day by day, month on month, right? Similar is the case of small cap scheme. If we talk about now the clearing corporations, which are a very important part of the financial markets, I will say the clearing corporation is nothing but they are sitting between the buyer and seller, right? So here is a buyer, here is a seller. It is the financial market. So clearing corporation is between to settle the transaction so that both the counterparties are tightly coupled here, and the whole job of clearing corporation here is to settle the payments from one party, and if there is any chances of default, to take care of the default chances as well, right? So clearing corporation, as the name says it all, is all about clearing and settling the transaction, right? So if we talk about the stress testing result here in the financial stability report, the minimum required corpus for core settlement guidelines core settlement guarantee fund. There is a core settlement guarantee fund. There is a minimum requirement for the core settlement guarantee fund, which is monitored monthly on a monthly basis. Now increased requirement in the commodity and equity derivative systems segment have been noted. So there is an increased requirement of the core settlement guarantee fund in the commodity and the equity derivative segment, right? What is this settlement guarantee and what is this fund all about? So settlement guarantee means the in case any of the trading member is defaulting, the clearing corporation still completes the settlement on the time, right? And for that there is a core fund requirement which is most strongest or most reliable financial buffer for this entity, right? Then here we can see the financial network in the contagious analysis. So bilateral exposure, SCBs are holding the largest shares, approximately 42%, more than 42% of the outstanding exposures, followed by the NBFCs and mutual fund. Then we already talked about the interconnectedness in the different financial institutions here, right? Instrument wise exposure is also there and internal sector flows are also there. Insurance sector, which is also a very crucial part, right, of the financial system. If we talk about the insurance sector, then premium and AUM growth, steady expansion with deceleration in the growth rate. The growth rates are going down, right? There is a expansion, there is a steady expansion, but the deceleration is there in the growth rate. So life sector concentration risk is also there, and the non-life sector is quite diversified as of now. If we talk about the claims and the expenses, then increasing the benefits paid by the insurer, life insurers, and the non-life claims dominated by the health and motor segment. So in the non-life claims, which is being dominated by the health and the motor segment. Reinsurance, we are again relying on the foreign reinsurance entities. We are going to see here in the insurance sector, it remains systematically significant component of the financial system. Why? Because having a look at the scale of it. If we talk about the AUM of the insurance sector, it is almost 74.4 lakh crore as of now in March 2025, and that too 91% of the total investment is coming from the life insurance. So there is a risk concentration here. Now I was talking about the life total premium life insurance pay. Then we can see that the growth rate is going down. The growth rate is going down year on year basis. So as of now we are on 6.7%, right? 6.7%. Non-life total premium 6.2%, again sharply went down in the last 2 years, right? And life insurance is having the most of the share, almost 81% share in the sector wise premium, right? So life insurance is leading the pack here. Reinsurance business within India, you can have a look that within India as of now it is 57.1%, and outside India earlier it used to be 26, now it is 29.2%, right? So this is the reinsurance share. The reinsurance share of, I will say, outside India is increasing year on year basis. It is increasing year on year basis, and that's what we have discussed. Solvency, the life insurance sector again shows improvements and a high degree of predictability and resilience. So there is an improvement in the solvency ratio side also related to the life insurance, plus the non-life insurance sector is quite stable as compared to March data, though it is in an uptrend as compared to the 2024 data. Now the third part is regulatory initiatives in the financial sector. So almost all the things we have already covered in separate videos. You can, whenever you get some time, you can watch different videos related to concepts, right? So here it is nothing but a compilation only of different regulatory initiatives taken by the Reserve Bank of India recently, right? So you can have a look at the climate finance related things, decentralized finance related things, right? Plus co-lending direction which RBI has released. RBI has also consolidated so many master directions recently, 9,000 plus instructions into 244 clear documentations, non-credit based facilities. So all these are free AI report. All these things we have already covered on the YouTube channel. You will find all the lectures related to these. Just type the keyword and you will get the lecture on All Aboard YouTube channel. ESG debt security framework can be very important for your examination. I have released a separate video related to SEBI Grows Green, BRSR and ESG program explained, so you can watch that video as well. It will be definitely very, very helpful for you guys to understand this in a detailed manner, right? Then deposit insurance related finance current affair also we have recently covered, that we are 97% of the accounts are fully insured here in terms of volume, right, in terms of number of accounts, right? And these are the areas I would like you guys to research on after this particular class. I have released a 10-pointer areas where you can focus on from this particular report later on, slowly, right? These are mostly static concepts only, and this yield curve steepening and flattening you can definitely refer. I have released a recent video related to the yield curve also. You will find that on the All Aboard YouTube channel, right? Now 2 questions guys for your homework purpose. Which segment shows relatively higher stress in the asset quality as per the recent Financial Stability Report? Question number 1. Which segment has shown the relatively higher stress in the asset quality as per the Financial Stability Report? So you have to answer this one. And as per the Financial Stability Report, notes that the International Monetary Fund has revised the global growth projection upward to 3.2%, while the India recorded a real GDP growth rate of 7.8% in Q1 of financial year 2026. Which of the following best explain this divergence? Which of the following best explains this divergence? So please do let me know in the comment section later on. What do you think should be the right choice here for both question number 1 and for question number 2? Right? Thank you so much guys, and you can also check out our 360 study kit which will definitely help you. Now you don't have to again and again watch the classes. You can derive quick summary, right, from the classes of the faculty members. You will also be having FAQs, quizzes, revision flashcards from the summary notes. Okay. And in case if you guys are preparing for the RBI Grade B examination, you can check out our paid course as well. Thank you so much. See you soon. And in case of any query, you can always let me know. CA Pratik Finance. When you type it on Telegram, you will find me. Okay. Thank you so much guys. Bye bye. Take care. Have a great evening. See you soon.